Welcome back, everyone, to the news channel with another stock prediction. The prior stock prediction was about Disney. Disney shares have really taken off since then. Would have already had a really nice return on that stock. So, as expected, I knew something was going to happen soon, and it is already happening. So, Disney has really made a nice move since the prediction was made. Again, all predictions are going to be in the description below the video at 100% success rate. All predictions have worked out well. So that's great. Just follow this channel to find out all the updates on new stock predictions coming up. And boy, do we have one here. Just take a look at this. And that's Hershey's. This stock has gone down probably more than any time in history in a specific period of time. Just take a look at this. This stock has really come down. The last time it was down this much, you have to go all the way back to 2007. And that was a year. However, in just the past 6 months, this stock is down 31%. Imagine a company like Hershey's, consumer staple, a defensive company, down 31% in just 6 months. And this is a historic proportion. All you have to do is just take a look at this. This has never happened before. This stock has been trading since the 1960s. I mean, this company has been around a long time, and this is really an unbelievable move. So the question is, should you get out? What's going on here? Or is there more to this story? Let's really look under the hood and find out what's really going on with this company. Let's see what's going on here. Is this company really in trouble, or what's the deal here? Imagine, a company goes down 31% in 6 months, and the S&P is strong this year. It's up strongly. So what's going on? Let's take a look. The revenue looks great. The revenue is going consistently up. It's the highest it's been in a long time, as you can see right here. Take a look at the net income. That's important. Consistently going up over time. That's also really good. The cash is up and down, but it is positive. Let's see what else is here. Operating cash flow consistently going up. See, that's also good. Net income consistently going up over time. So, if you look at the balance sheet, it's going in one direction, but you look at the stock, it's going in the exact opposite direction. So what's going on here? Why is this happening? You could see it, strong balance sheet. Let's look at something else that's important. And this is something called a moat. This company has great brands. It has brands that people buy, that they enjoy. Very popular food company, as you can see right here. One of the most popular snacks in the US. We have Hershey's own brands. We're ranked in the top 10 most popular food and snack brand in America. Take a look at that. It's right here, they're in the top 10. Let me just point out, this is a great business because when people buy their snacks, and chocolate, and things that they sell, they're consumed quickly and they need to be purchased again. So this is like, you don't have to worry about advertising and anything else. It's a brand that's already out there, and they're going to continue to buy it and buy it and buy it by popularity among children. This company is among the top brands in the world. It's very popular, very in high demand. It's just overall a great business. Here's all their brands. Look at these brands that they have here. These are some of the most popular brands in the world. So what is going on here? Why is this stock going down? Well, there's a few reasons. And I mentioned this before. This is very important. I want you to pay attention to this. The sector is just not doing well. So you can have a company that's hitting out of the park, revenue, cash flow going up, net income going up, all the things you like to see in a balance sheet. But if the sector itself is not doing well, the stock's going to go down anyway. That's how this business works. Investors sell everything. Even if there's some bad companies that are in this sector, they're going to go down even with the good companies. That's the way it works. You saw that with tech last year. A lot of good tech companies, large tech companies, they were all going down together. And let's take a look at that. So right here, it's down 5.3%. So this is one of the worst performing sectors in the stock market right now. This sector is not doing well. And if you look at other companies like Coca-Cola, McDonald's, they've also gone down hard this year. So all of them are going down. Hershey's has gone down more than a lot of the other large, well-known brand consumer staple companies. So it's not doing well because of the sector. Now, here's another reason. They're saying that this drug that came out is going to affect people's purchasing of snacks. And as a result of that, it can hurt the profits of some of these companies. I think this is short term. And the reason I mention that is because there was a big downturn in the sugar market back in the 1980s. And back then they had these alternative sugar substitutes that were coming out that sugar could cause health problems. The reality is that the sugar market made historic lows during that time. It pushed the price down, but then it just shot right back up hundreds of percent in a short period of time. So sugar wasn't going to go out of business. And neither are companies that sell snacks. This is just going to blow over. I mean, this is a drug. Who knows what the side effects of this drug is? It's an expensive drug. Not everybody can afford it. So it's not like this is going to have an effect of what people think it might have, just like in the past with the sugar substitutes. As a matter of fact, they found out one of them, saccharin, wasn't even healthy. And I think that was banned from the market back then. So that didn't even turn out to be affecting sugar in the long run. But in the short run, it can cause the prices to go down. Now, if you look at the other consumer staples, they rebounded. Like Coca-Cola, that stock has come back. PepsiCo has come back. Look at the other companies. But if you look at Hershey's, the stock has really come down. I mean, I think this is, in the past 6 months, this may be the biggest drop this company has ever had since it was publicly trading back in the 60s. What's the best way to approach this right now? The stock is trading around at $188 a share. What might be a good idea is to possibly take a position here. Or if you want to get in possibly at a better price, there could still be some more downward move here. It looks like it's starting to stabilize and form a level of support right here, but it can go down even more. You could possibly look at selling some puts in the 187, 185, 186 range, around that range. Maybe take a position, get in at a low price. If the stock comes back down there, you could start building a position here because I think this stock is going to turn around at some point. Now, what is this company really worth? So let's take a look here. And analysts, what they think, where this company is going to go. This is kind of unusual. Usually if you look at the low end, it's usually below the stock's price, but look at the low end. Analysts that are more conservative, where they think the price could go, it's at 195. So that's still substantially higher from where the price is right now. So most analysts think that this stock is undervalued. If you really do an intrinsic valuation, this company is worth in the 240s range. Could it go down more? Yeah, it could. Sure, it can. 31% in just 6 months. That's pretty bad. Like I said, I haven't seen anything like this before. These companies generally, sometimes they go up even in a down market. To see a company like this that's doing so well, that's moving down so hard, especially its size, its brand, its history. I haven't seen anything like this before. So I think that this company is going to go up from here. I think this could be something to definitely consider as an investment. So those are two ways to go about it. Now, let's say you're very conservative and cautious. You're looking at the low end of the target of 195. Hey, from where it is now to 195, if it gets there in a short period of time, that's a really good investment. If this stock has actually bottomed out, don't need to worry about a stop loss order. It's a great business. It's doing well. It's been around a very long time. That could be a really, really nice return. But I think this stock can go up 10, 20, maybe 30% from here in not that long of a period of time. And here's the sweetener, no pun intended. It pays a dividend. So you get paid to hold it as well. So if it takes longer to get there to your target, whether that might be 15, 20, 30%, you'll get paid some money to hold it. So I think this is something to definitely consider, something to look at. So I would like to know your thoughts. What do you think about Hershey's? What do you think about the consumer staples sector? Where you think it's going to go and the overall stock market? Please leave your comments. Please subscribe. Please like this video. And thank you for tuning in.